Hello, my name is Alex Brandreth from Lunar Investment Management. Welcome to this quarterly update. It's certainly been another interesting quarter in markets. We've had inflation continue to fall down. We've had interest rates increased, but then paused in the UK and the US. And today we're going to go through these points. It was certainly a better quarter for UK assets. As we mentioned, inflation is stubbornly high, but is falling. Interest rates were increased in August, but paused in September in the UK. And this is going to have a knock-on impact, and is having a knock-on impact into the saving and mortgage market over the coming years. Bonds, fixed income assets, look attractive after a challenging 2 years. So let's just quickly look back at what happened in the quarter. This looks at the major equity markets up for the third quarter, and you can see most markets pretty much traded sideways in quite a little bit of volatile fashion. The Hang Seng, that purple line, being the most volatile. If you look the right-hand side, the best performing market was the FTSE All-Share, which was up just under 2%, and that's that kind of maroon colour there. On the flip side, it wasn't as strong a quarter for European equities. European equities were down 2%. Other markets were broadly flat during the quarter. What about fixed income markets? So this looks at corporate bonds in red and government bonds in blue, and strategic and emerging market bonds in the yellow and green. And you can see it was a much better month for corporate bonds, increasing by 2% during the quarter. Gilts initially fell quite heavily in August with inflation and interest rate concerns, but they rallied back towards the end of the quarter and were down slightly. But that's about what's happened. Let's have a look at what's going on with the economy and what's impacting markets. On the left-hand side here, you can see real GDP growth, so taking out inflation. And economic growth within the UK has basically flatlined. This goes back to 2012, and you can see that economic growth was a nice steady range. We then had the pandemic and economic growth collapsed. The economy reopened and the economy rebounded very strongly. And more recently, that's been dwindling, and economic growth has been more modest. The July GDP data actually showed the UK economy contracted. So it's a very weak picture of basically flat growth within the UK at the moment. On the right-hand side, we look at PMI data, Purchasing Manager Indices. And they're important because they give you a real good guide of what's going on with the economy right now. And that's that grey line. And that tends to lead what goes on with economic growth. So it's important to see what's going on. As you can see, this chart goes back to 2000, but I really want to concentrate just at the end of this chart here. And you can see it's just gone into contraction territory. So the PMI data is actually showing that the economy is slightly contracting at the moment. That being said, as you can see, it fell negative earlier on in the year, and we didn't go into recession. So it's not always a perfect guide, but economic growth is certainly weak within the UK. And one of the reasons for that has been this high levels of inflation that we've been suffering throughout the last few years. This chart goes back to January 2021, and you can see the different components that have contributed to inflation picking up. Core services in blue, core goods in green, food and alcohol, that's been a big topic in purple, in supermarkets. The big one that we all know about, electricity and gas in grey, and then liquid fuels in that kind of limey green colour. The limey green colour has actually been a deflationary impact more recently, as the petrol prices have been falling. And you can see those grey bars have been gradually falling and been not having a bigger impact on inflation. In fact, as we go into October, it's expected they'll turn to be a negative deflationary force as well, and inflation will continue to fall. So keep an eye on inflation, because it's going to be hitting the headlines, hopefully for the right reasons this time, and it's falling a lot quicker because of these deflationary forces. On top of that, food prices look to a peak and aren't increasing at the same rate as what they were. So it's definitely a better picture from an inflation perspective. That being said, we're still well above the Bank of England's 2% target at over 6% inflation. And that's why interest rates have increased so quickly. They've increased from basically 0 to 5.25 over the course of nearly 2 years. And it's been a big impact in terms of different markets, and we'll touch on the savings and mortgage market shortly. That being said, we think we're very close to the peak in interest rate cycle, and that's been a headwind to asset classes over the last 2 years or so. But that headwind is no longer going to is in the rearview mirror now. If interest rates have peaked, and we're correct, then there won't be as negative driving force for investment markets going forward from this point. What's the impact been on the saving and the mortgage market from interest rates going up? Well, Obviously, the cash in the bank that you're getting is now receiving a higher interest for the first time in nearly 20 years. Mortgage payments have obviously increased as people refinance at higher rates, but the impact of mortgages happens at a slower rate because everyone's on fixed rates for a long period of time. And on the right-hand side here, you can see, well, what is the mortgage roll-off going to be? And you can see it is gradually increasing to 2027, but there's a very lagged impact. And that's why on the left-hand side, we're actually, as net as a country, we're actually feeling wealthier at the moment because the interest we're receiving is coming through quicker. So I think there's been a lot of focus on the negative impact of interest rates, and there are going to be individuals that are impacted by this, but the savings impact is also very important to consider as well. And that's not just for individuals, that's for corporates as well. One of the questions that we're getting at the moment is we're getting a very secure rate of return from cash. Why bother investing? And this chart really looks to tackle this issue. So in the grey bars, it shows the returns from asset classes on an annual basis in the 1990s when we had higher interest rates. And in blue bars, well, what happened in 2010s when we've been in this decade-long period of low interest rates. And as you can see, the blue bars and the grey bars gradually increase as you go from left to right. So the more risk you take, you go from cash to government bonds to UK equities, you gradually get a higher return. And we'd expect this to continue into the 2020s as we are now, because now you can buy a government bond with a higher return on cash, and equity markets from this level look attractive going forward. And we'll touch on them specifically now. So as we just said, bonds are back. This chart goes back 5 years. It looks at the 10-year UK government bond yield. And as you can see, when we were starting Luna in the middle of 2020, the return on a UK government bond was around 0.5%. We were almost, and that's for 10 years, we were almost guaranteeing to lose people money. The only way that we could make money is if interest rates and gilt yields actually went negative. But fast forward, interest rates have been increased and gilt prices have repriced significantly. And that to us presents an opportunity within portfolios because gilts are good diversifiers. In times of risk, that they appreciate in value as well as equities fall. And we haven't been able to pull on these within portfolios for a long period of time, but bonds are definitely back. And this table here looks at the different types of government bonds that are available. It just focuses on short-dated government bonds. On the left-hand side, you can see the different maturity lengths. So one from the end of January 2024 all the way out to October 26. Because these bonds have been issued in a low interest rate environment, you can see the next column, the coupon is very low. That's important because bonds income is taxed at your marginal tax rate. So what happens, because the coupon doesn't change, the price has to change. So because interest rates have gone up, the coupons that are available are no longer as attractive and the prices are just lower. And you can see that the prices on these bonds vary from all the way down to 88 pence to 98 pence. And what happens with a bond is it's priced at £1 and it matures at £1. So as we move through to 2026, October 2026, that 88p is going to mature at 100p. In the way that we calculate this gross redemption yield is by combining the coupon with the recovery in price on an annual basis to 100p. And you can see there that the return on government bond is anywhere between 4.6 and over 5% at the moment, and the average rate is 4.8. So you can get a 4.8% return, which is mostly coming from that price. Now, the important point about that price is to an individual, any recovery in price to £1 is completely tax-free of capital gains tax. So they're quite a tax-efficient product to be buying at the moment as well. Now, if you were to invest that money in cash, you can clearly get a high savings rate at the bank at the moment, but that tax is taxed, income tax. So you can see here, we put on the right-hand side, well, what if you're 40% tax-free? You need the equivalent return on gilts to be 7%, which is clearly the equivalent cash return to be 7% to get the same return as you are on the gilt market at the moment, considering the tax benefits. So there's definitely a place for fixed income investments in your portfolio. And if you've got some surplus cash in your bank account at the moment, there might be a more efficient way of using that cash. What about the equity market? This shows PE ratios. It goes, the bars go back from 1990, show the lowest level and the highest level. Effectively, a low PE number down here means markets are very cheap. A number up here at kind of 30 means that markets are very expensive. At the moment, the green bars represent the average since 1990, and then we've got the blue diamond, which represent the current level. As you can see, these four markets on the right-hand side are trading a lot cheaper than their long-term average, which means they're good value. And one of the key things for investments that we must concentrate on is buying cheap assets, good quality cheap assets, I should add. But on the left-hand side, you can see, well, US markets are actually a little bit more expensive. And we've been touching on this a lot recently with the artificial intelligence surge that's come through, and the recovery in share prices from low levels from 2022, which has seen the tech names bounce significantly. That's all. That was a quick update in terms of what we're seeing within the world. As we touched on, interest rates look to have peaked. Inflation has started to moderate and will continue to come down. Interest rates being high has repriced all asset classes. To us, selective equity markets look attractive, and bonds certainly look attractive for the first time in nearly 20 years. Thank you for listening today.